Good morning, everybody. Welcome to another day of Market Report brought to you by Mike Bjork. Today is Friday. Happy Friday to you all. It is January 29th, end of the month here. Hey, we got a couple economic news releases to go over. So we'll start off with the GDP, or the gross domestic product. And this is the first report coming out for the fourth quarter. We get three revisions here. So this will be the initial one. So Q3 ended at 2% growth. And then the forecast for Q4 was at 0.7. It came in expectations. So obviously not a very good fourth quarter, especially when you get Christmas, the holidays, everything else. Not a very good number there. We also got the employment cost index, which we still see costs of employment going up. So the previous reporting came in at 0.6% in the third quarter. So forecast of 0.6, and it came in at 0.6 across. So costs are going up for employing people as well. Consumer sentiment down a little bit here, a little disappointing. So after being at 92.6, they were forecast to go up slightly, and it actually went down to 92. So people weren't feeling as rosy as the previous month. But the good news is Chicago PMI jumped up. Manufacturing in the Chicago region. So before we were in contraction mode with the 42.9. So anything below 50 is considered a contraction, and even the forecast of 45, and we surpassed that. It jumped up to 55.6. So good manufacturing numbers out of Chicago, which we've been kind of seeing a lot of negatives of late, contraction, especially in the Northeast. So it's good to see something come good out of Chicago here. Stock market's up today. Actually, Dallas so far was up around 200 so far this morning, and a lot of it is the big surprise. The Bank of Japan surprised everybody when they came out with negative interest rates. So essentially with the negative interest rates, what that means is that what they're trying to do is, and you may hear this coming forward, even with our own Fed, if they need to try to stimulate the economy further, this might be a tool that they may use. And essentially what this is a lot of the banks, when they're borrowing money from the central bank, they're kind of hoarding the cash. They're not lending it. So they're exceeding that levels because it's basically cheaper or very little cost to them borrowing from the central bank, and they're hoarding that cash above their reserve levels. So this is going to basically penalize anything above the reserve levels. It's going to go as a negative, which is going to cost them even more money for borrowing that money. So this is what's going to happen. So basically it encourages them to take more money out, put it into, even investors, to put it out into the market with higher yielding results, and hopefully stimulate the economy in that nature. This is what you saw in Europe, that the central bank has kind of done, European Central Bank, or Switzerland, a few countries in Europe, and now Bank of Japan. And this is something you may even see the U.S. come up if we can't get things going a little bit faster here in the near future. Bond market's also up. We're down for the day, but we're up about 25 basis points from where we left off yesterday, which helps improve the interest rate. So we'll have a nice improvement in our interest rates. Now, we are getting a bit off this 200-day moving average, and anytime you get too far off, you'll probably see a whipsaw effect, basically getting pulled right back down. So at some point, I would expect some type of correction, get it pulled down to the 200-day moving average, which is kind of a healthy move. It helps us out so we can continue growing, but at some point you'll have some type of correction to pull it down. So be cautious. I would kind of look towards maybe locking at some point here with this if you have any interest rates you're floating out there, just because we're getting a little farther up from the 200-day moving average. All right, folks, you guys have a wonderful weekend coming up, and we'll see you guys on Monday. Thanks for watching. Bye-bye.